Good afternoon. I thought it would be appropriate to talk to our clients, particularly in the financial planning area, about the events of the last couple of weeks, but particularly over the last week. To say that these situations have been extreme is probably understating it, and certainly the way that investment markets have reacted has also been extreme. I think the thing with this coronavirus is that it is probably a lot more visible in terms of as compared to other events, and that does create a whole lot of panic. For reasons that I'll mention a little bit later on, I still feel that this situation is significantly different to what occurred with the global financial crisis. But let's, for a moment, consider what is actually happening. I think the first thing to recognise is that share markets hate uncertainty. And what is the issue at the moment with this moving event is there's massive amounts of uncertainty as to what the impact will be in relation to economic growth around the world. To give an example, if a vaccine was discovered and was able to be put in place within a month or two, obviously that would dramatically change circumstances. We know that that's probably unlikely, but it is totally subject to these events. What I think is important to recognise is that where it evolved in China certainly appears to have got ahead of the game, having had a slow start, and what we're seeing is that the various infections are now starting to reduce significantly. It's an autocratic society, and it's a lot more difficult, I suppose, for democracies like Australia and Europe and the US to do it maybe as effectively as that. But I believe that we will. And China is a very good example, I think, of what can happen and how quickly it can occur. There's no doubt that over the next 4 to 6 weeks, things will get more difficult. And in that regard, it'll be very visible. Further lockdowns, less social contact. But all of that's happening for good reason, obviously to get ahead of the curve, as is being stated by the government and the health officials, to not have too much overburden on the health system, and so that we have time to deal with the matter. And I think Australia will deal with it and deal with it very well. We've seen the incidences with the toilet paper situation. In one sense, it's quite amusing, and in another, it's not. It just shows the basis or the basics of human nature when people are under pressure. And that's sort of what we're seeing in the share market. I would use an example of BHP. When the previous CEO left BHP, that company's probably in the greatest health it's been for many, many years. Magnificent balance sheet, and the best miner in the world, with massive productivity gains over the last 10 years. China is not going to go backwards. China will stimulate, and I think companies like BHP will continue to have huge opportunities. It's down 35%, and you've got to ask, well, is that justifiable? I don't think it is. So this downside risk at the moment could continue. There's no doubt about that. How low it will go, we do not know. But what we've got to do, as I said earlier, is actually have a look at the facts. And I think the facts are that this will not be Armageddon, that we will get ahead of this. And last Friday, I was privy to a podcast with Shane Oliver from AMP, discussing a number of things, and a very, very respected economist, and he basically put some hard facts on the table. He used China as an example as to how things can improve, and that eventually there will be an antidote for this particular disease, and that I think generally, notwithstanding the lockdown, that economies will get ahead of it. His base case is that we will probably have 2 quarters, including March and June, of negative growth, and for the first time in nearly 30 years this country may fall into recession. He feels we'll see pick up in the second half. Worst case scenario, there could be a third quarter of negative growth, but it will pick up. So the view is that the turnaround in relation to this particular black swan event, if you like, will be quicker than what it was with the global financial crisis. The global financial crisis, albeit that maybe it wasn't quite in your face as much as this in terms of the health issues, etc., I do believe it was a far more severe economic and financial event than what we are experiencing at the moment, because there was grave concerns about the health and viability of the world's financial system at that time. Governments and central banks had more firepower to deal with that particular issue because interest rates were that much higher and there's a lot more capacity to reduce rates than what we've got now. But there's no doubt that the central banks can still, through various forms of quantitative easing and other things, definitely assist. We've also seen the government recently coming out with a first stage package which will certainly help with stimulating the economy, and there are more things that they can also do in that regard. So I'm not totally negative about how this can be dealt with, albeit that there are, this is about life and death situations which no one should dismiss. Companies, both large and small, will have their growth and profitability impacted, and this is the very issue with the share market. I believe that the share market is overstating the downsides, as it inevitably does. What we learnt a number of years ago from the global financial crisis and with us dealing with our clients on a regular basis was that the last thing that you should do, unless it's necessitated by high levels of gearing, is to sell quality assets into a falling market. And particularly at the moment, you turn around and say, well, where does my cash go? Because it's going to go somewhere where, yes, the capital may not fall, but the income that you gain from that capital is going to be not a lot. And what we found was those clients, and fortunately we didn't have many of them that did this based on our advice, but there were many people who got out of the share market when their investment portfolios at half and never got back in and never benefited from the inevitable upside. And the upside from this will happen quicker than what occurred with the global financial crisis, which is something I'm very confident about. Equally, even though your assets based on the Australian share and international share markets have fallen by 30 to 35%, they still generate an income, much more than what you will get on interest. And those shares, particularly at the quality end, will bounce back. Also, the majority of our clients have extremely well diversified portfolios, and we have been cautious now for some time about where markets have been at. And so most clients are on a balanced portfolio or even more conservative. And so the falls on their macro portfolio is not going to be anywhere near like 35%, because what's actually happened is some of the fixed income trusts that we have clients in have, over recent weeks, have gained significantly and have buffeted the losses in terms of the equity markets. Clients who have available cash, in some instances over recent days, on our advice, have slowly started to buy into these falling markets. That's not because we think it's the bottom, because we think there could be a lower point, but it's about averaging into quality assets. The interesting thing about cash is people often say that cash is wasteful because it doesn't earn much at the moment, but that's not the way to look at cash. You have to look at cash from the point of view of the opportunity it can present you when markets do fall. And if you've got available cash, or you can move from some of your conservative assets like fixed interest into growth assets that have come off of the order of 35%, the relative value of that cash becomes very, very significant by what it can buy. And what it basically means is that if those markets come back over the next 6, 12, 24 months, even 3 years, if you look at the return on that cash, in that instance, it's very significant, even though it hasn't earned you much up to that point. And so we have had clients slowly investing back into the markets. We haven't had a chance at the moment to talk to all clients, and this is really the purpose behind this video address. What our very strong advice is not to sell into this market. If there are some defensive assets, and we are, let's say, maybe arguably even too defensive, now might be the opportunity to gradually look at deploying some of those defensive asset classes into these low markets. We're not saying all of it, we're not saying it's all done at once, but it could be a gradual thing. Those clients where that situation was obvious, we've been working with over the last few days, and we really didn't start doing this until yesterday. Because these portfolios are well structured and well diversified, they will hold up during this difficult times in markets. But they will also provide optionality in that clients will be able to, as I've said earlier, move in progressively into more growth assets. Younger clients and clients with more growth-oriented portfolios clearly will have been hit harder. But it's because they've had these growth portfolios that they've had the gains, not only over the last year or so, which has obviously been clawed back now, but over an extended period of time. And again, there is the last thing that should be occurring there is having these portfolios become more defensive. The best thing is to continue with the contributions into those portfolios, be they superannuation or other forms of contribution, and to buy progressively at these lower rates over time, because all of this will come back. And when you need the money, those portfolios will be substantially more than they are today. So I think in summary, these difficult times can also be seen to provide opportunity. People should act rationally. They should think through the issues that I've discussed today and not be too concerned, because the sun will come up on the other side of that hill, and we are here to help you in looking at these issues. We've been there before, 12 years ago, and as I said, I feel that deep down that was a crisis that was of a greater magnitude than what we're currently going through, even though it may not seem that way. We're here to help, and I think once you've had an opportunity to review this video, by all means, please give me a call if I haven't got to you before then, to discuss these matters more specifically in relation to your own facts. Stay healthy, and we look forward to talking soon.